All right, we're now going to head back down to the New York Stock Exchange and bring in the exchange's Chief Operating Officer, Larry Leibowitz. Larry, thank you so much for joining us. Let's talk first of all about, obviously, we're going to focus on the 1,000-point drop that we saw on the Dow, but all the peripherals as well. There were no system errors from the New York Stock Exchange side.
That's correct.
So do you have any idea what caused the precipitous drop in such a short amount of time?
Sure. What happens is when a large order or a series of orders comes into electronic markets, they don't really have any way to recognize either that they're a mistake or to slow them down to attract the proper liquidity on the other side. And so the electronic markets actually traded all the way through the slower New York Stock Exchange markets where we were trying to slow down the trading.
So did you see, does that mean you did see a big mistake here? Was there, I mean, did someone type in a B when they meant to hit an M, as we've been sort of hearing all day?
Well, we don't have confirmation of that, and to be honest, we won't be able to know because the orders actually came in through NASDAQ. So we don't have the other side of the trade. We don't know who originated the trades, but I'm sure they're investigating that and they'll be able to figure that out.
So, Larry, let me ask you, because we were all watching so closely because that 1,000 point or nearly 1,000 point on the Dow, I mean, it came so fast, it was so steep. I mean, do you feel like the whole decline today was because of these erroneous trades?
No, it seems fairly clear that it didn't. In fact, the market had slid to down maybe around 500. If you look at the chart, you can see fairly clearly where the trades came in. It's that V-shaped drop where it came down, then snapped right back up because, you know, you had some very high cap stocks trading down 50% or large percentages in a split instant because there really was no liquidity in the electronic markets.
So a lot of the prices were unreal. I mean, as unreal as they looked, I'm assuming nobody was going into Accenture and snapping it up at 1 penny a share.
Well, in fact, some people did buy it at 1 penny a share.
Wow.
And what's actually happening now is there's a policy called erroneous trades. And what it means is that when a stock dislocates more than a certain amount on an order, particularly like this, the exchange actually will review it and either reprice the trade or take it off the tape. And right now, all of the exchanges are on a conference call figuring out which trades stand and which trades don't.
So our buddy who bought DBY at less than $20 and then watched it bounce back up to 45 and change, that trade may be undone.
That's absolutely correct.
Larry, do you feel like what happened today was an aberration, or do you feel like that this is showing that there are some fundamental problems within the trading system, as some of our guests earlier today alluded to?
Well, we certainly feel that there is a role for people in a marketplace, even a marketplace largely dominated by electronic trading. That's why we have market makers. That's why we have these spots where the market actually goes slow so that a person can find the other side of a trade. We think that having purely electronic markets all the time can run you into trouble at times. And we saw it not only now, but also in the fourth quarter of 2008 when we had that high market volatility during the crisis.
All right, so walk us through, because we were kind of breaking all of this down, you know, as we watched the trade go down and bounce back up. So what happens next then? You mentioned everybody from the various exchanges are talking. What happens next? Well,
what happens is all the exchanges have similar rules on their books that say if a stock dislocates more than a certain amount in a certain period of time and it's clearly a mistake, that the trade will be broken by that amount or repriced by that amount. What the exchanges are doing is coordinating which trades and what percentage move will be taken off the tape in which prices, in which stocks. Obviously, there are a lot of market participants who really want to understand what's going to happen to their trades.
Will your safety procedures, your automatic stops, will your rules at NYSE Euronext be reviewed here?
Well, obviously, the regulators will be reviewing everyone's role here. We're very pleased with what happened on the New York Stock Exchange, where we didn't trade through significant levels, where the markets were slower. If you actually look at the New York version of the Dow, my guess is it didn't drop nearly as much as the composite version that most people are looking at. And so I think that this is an example where there are times where a fully electronic market has difficulty with blasts of liquidity.
Larry, let me ask you, when you saw the declines and how fast they came and how steep they were, did you know right away, was your inclination that there was a problem within some kind of trading or some exchange, or were you more concerned, or were you thinking that, you know, the fundamentals have been weakening, certainly when it comes to Greece and other European nations?
Well, you know, it is different than if we were on a quiet day and nothing were happening and suddenly it dropped that way with no news. In this case, there was news, so you don't know right away, is it real or an aberration. The fact that it snapped back so quickly made it clear that it was an aberration.
All right. Hey, Larry, thanks so much for joining us. Larry Leibowitz, their Chief Operating Officer at NYSE Euronext, talking about what happened there.